There is a piece of paper sitting in millions of American homes right now. Some people have it saved as a PDF. Some have it printed out, tucked in a folder, maybe highlighted in a couple of places. And every single time they look at it, they feel safe. But I need to tell you something your financial advisor knows, something the people who wrote your 401k brochure know, something every Just Buy the Index and Relax podcast quietly skips over, because saying it out loud isn't exactly good for business. You don't own 500 companies, you own 7, with 493 extras thrown in to make you feel better about it. This is the Magnificent 7 Trap, and today we're going to cut it wide open. It is 1720. France is broke, genuinely, historically broke, after too many wars and too many catastrophic decisions made by people who would never personally suffer the consequences. And into that chaos walks one man. His name was John Law. No royal title, no inherited wealth, just an outsider with a silver tongue, an elegant theory, and absolutely zero chill. He convinces the French government, the entire national government, to hand him control of their bank. Think about that for a moment. One man, one bank, one country's entire financial future. In a single pair of hands, within 2 years, he had created something the world had never really seen before. The world's first viral investment trend. People weren't just buying shares, they were consumed by it. They were camping outside his house, selling their jewelry, liquidating property their families had owned for generations, all to get in on shares of a company that supposedly owned enormously valuable land across the Atlantic. Here is the spoiler. It was swamp. Louisiana swamp, to be specific. No gold, no profitable trade routes, no revenue of any meaningful kind, just paper, and the story people told each other about the paper. The share price went from 500 livres to 18,000 livres in under 2 years. People who had been ordinary middle-class citizens were millionaires on paper. The whole country was intoxicated, drunk on the idea that wealth could be conjured simply by believing in it hard enough. Then, in 1720, someone asked a perfectly reasonable question. Can I convert this paper back to gold? The answer was no. Within 6 months, shares crashed from 18,000 back to 500, then to 0. The French economy collapsed so completely that they banned paper money for decades. The architect of the entire scheme, the man who had stood at the center of it all, fled the country and died broke in Venice 9 years later. Now here is the part I need you to really sit with. The government got out early. The insiders got out early. The regular French citizens, the merchants, the small business owners, the families who trusted that the system was built to protect them, they were left holding worthless paper. And the bankers who made it all possible faced almost zero consequences. They just moved on to the next opportunity, the next scheme, the next generation of people willing to believe. Does any of that sound familiar? Because I am about to show you the 2026 version of that exact story. And this time, the swamp has a much more respectable name. It is called the S&P 500 Index Fund. All right. Let's do the autopsy. No jargon, no intimidating charts, just the math and what it actually means for your life. As of early 2026, the S&P 500, the index that every retirement brochure, has over 30% of its total value concentrated in just 7 companies: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla. 7 companies. Out of 500, that is 1.4% of the index, holding nearly a third of the weight. Back in the 90s, the top 7 made up maybe 15%. We have more than doubled the concentration in 25 years. And somehow, everyone's acting like that is completely normal. Now, I want to give you an analogy, and I am going to ask you to forget every eggs in a basket metaphor you've ever heard. Think about the human body. A healthy body has blood flowing everywhere to 500 different tissues, organs, and systems, each one doing its job. If one kidney takes a hit, the rest of the body compensates. That is what real diversification looks like. Distributed, resilient, no single point of catastrophic failure. But here is what your index fund actually looks like right now. Imagine 30% of your body's entire blood supply being routed through a single artery, just one, and that artery feeds 7 organs. Everything else in your body still exists. Your 493 other tissues are technically there, but they're running on a trickle. Now ask yourself, what happens when that one artery gets a clot? Here's the part I want to address directly, because I know what some of you are thinking right now. The valuations on these 7 companies aren't nearly as extreme as past bubbles. The Magnificent 7 isn't trading at 80 times earnings like the Nifty 50 did. And you know what? That is a fair point. It is actually correct. The Nifty 50, those 50 supposedly untouchable blue chip stocks of the early 70s, were trading at price-to-earnings ratios of 50-60, sometimes 80 times earnings. Companies like Polaroid, Xerox, Avon, Kodak. The consensus was simple. These companies are so dominant, so essential to American life, that valuation simply doesn't matter. Just buy and hold. Then 1973 arrived. Oil crisis, inflation. Recession. Polaroid fell 91%, Avon fell 86%, Xerox fell 71%. And if you had bought at the peak in 1972, some of those took 25 years just to break even, not counting inflation, a quarter century of zero returns on the safest stocks in America. So yes, the Magnificent Seven's Peace and Buy-E ratios today are lower than that, somewhere around 22 to 28 times earnings collectively, not 60, not 80. But here is what that comparison quietly misses. Concentration risk and valuation risk are two completely separate diseases. Valuation risk asks, is this stock price too high right now? Concentration risk asks something far more dangerous. Is your entire financial future structurally dependent on a small handful of outcomes all going right? You can own a reasonably priced stock and still have catastrophic concentration risk. These are not the same conversation, and conflating them is exactly how people get blindsided. Let's talk about Nvidia for a moment, and I want to be clear, this isn't about tearing down a remarkable company. The technology is genuinely revolutionary. The infrastructure being built around artificial intelligence is real, but in 2023, Nvidia was worth around $300 billion. By early 2026, they had crossed $3 trillion. That is a 10 times increase. In under 3 years, their revenue grew, yes, but not 10 times. What grew 10 times was the multiple investors were willing to pay, the story. The expectation, the collective belief that this trajectory would simply continue forever. Think about it for a moment. If Nvidia drops 50%, which isn't some fringe catastrophe, it has happened to every high-flying tech stock eventually. That single event removes nearly 5% from the entire S&P 500. Add similar corrections for Apple, Microsoft, a couple of others, and you are down 20 to 30%, even if the other 493 companies perform perfectly fine. And the thing nobody's talking about at the dinner table. The index is designed to hide this from you. They call it diversification. 500 companies. Sounds safe. Sounds distributed. Sounds responsible. But when 30% of your money is concentrated in 7 of them, you are not diversified. You are concentrated. With extra steps and a friendlier label. Here is the part most people skip over entirely, and it is quietly costing people real money. If you have a target date fund inside your 401k, something like a Vanguard Target 2035 or a Fidelity Freedom 2040, I need you to listen carefully right now. These funds sound intelligent. You choose your retirement year. The fund adjusts automatically over time. It feels like cruise control for your financial future, safe, managed, professional, almost effortless. But most major target date funds hold a significant portion of their equity allocation in standard cap-weighted index funds, which means they are carrying the exact same Magnificent 7 concentration problem we just autopsied. The label says 2035, the contents say something very different. Tonight, not next week, tonight. Go look up the top 10 holdings inside your target date fund. Vanguard, Fidelity, Schwab, they all publish this. It takes 5 minutes. Add up those percentages. If your top 10 holdings represent more than 25% of the total fund, you are concentrated. You just didn't know it, because the label said 2035, and that felt like a seatbelt. It is not a seatbelt, it is a suggestion. Let me step back from the numbers for a moment. Because this next part isn't about math. It never really was. There is a version of this story that plays out in every generation, not because people are reckless, not because people are uninformed or careless with their futures, but because people are tired. You are working 40, 50, sometimes 60 hours a week. You are raising children, or caring for aging parents, or somehow doing both simultaneously with a smile on your face. You are watching the price of groceries quietly outpace your paycheck month after month, and somewhere in the middle of all of that, from a coworker, a podcast, a glossy 401k brochure, someone says, just put it in the index fund. Forget about it. The market always comes back. And you did. Because that is a reasonable thing to do when you are exhausted, when you don't have a finance degree, when the system is supposedly working in your favor. But here is the truth, nobody puts in the brochure. The system wasn't designed for you. It was designed for the people collecting fees from you. When a brokerage tells you to buy a cap-weighted index fund and hold it for 30 years, they're not wrong that it beats most active managers. That part is genuinely true. But they are lying by omission when they don't tell you that the index has quietly become a concentrated technology bet, wearing a diversification costume. I want to tell you about Japan, because this is the example that stays with me long after every other statistic fades. In 1989, Japan's stock market was the largest in the world. The Nikkei index hit 38,915. Japanese companies were buying American real estate. Economists were writing serious, respected books about how Japan would overtake the United States economically. And Japanese stocks were trading at 60 times earnings because growth felt inevitable, unstoppable. Imagine you were a Japanese teacher in 1989, a factory manager, a small business owner who had spent decades building something modest and meaningful, and you put your retirement, your entire retirement, into the Japanese index and held it. You lost 75% over the next 3 years. The Nikkei bottomed around 7,000 in 2003. As of 2026, 37 years later, the Nikkei has only recently recovered to its 1989 peak. Now, Japan had specific structural problems, demographics, zombie banks, deflationary spirals that proved almost impossible to escape. I am not telling you the United States is Japan, but the lesson isn't avoid stocks forever. The lesson is this. The market always comes back is only true if you are talking about the global market across an entire century. Specific markets, even the most dominant, most celebrated ones, can stay underwater for decades. And if your retirement window is 15 years, not 100, that distinction matters enormously. Here is something else that rarely gets explained with the clarity it deserves. Imagine two people, same age, same income, same average annual return over 20 years, but one person experiences a major crash right before retirement. The other experiences it early in their career, when they still have time, income, and options to recover. Same average return, completely different outcome. The first person runs out of money. The second person is fine. This is why losing 25% of your portfolio at 55 is not the same as losing 25% at 30. At 30, time heals it. At 55, that loss might be permanent, in terms of what your retirement actually looks like, in terms of whether you get to stop working when you plan to. And if 30% of your portfolio is sitting in 7 stocks priced for perfection when that moment arrives, the math gets very ugly, very fast. One more thing I want to address, because it comes up constantly, and it deserves a real answer. People ask about dividend funds, high dividend ETFs, funds built around stable, cash-generating companies rather than pure growth momentum. And honestly, that instinct is smart. A dividend-focused fund naturally pulls your exposure towards sectors that aren't the Magnificent Seven: utilities, financials, consumer staples, companies that generate real, tangible cash flow and share a portion of it with you directly, regardless of what the market is doing that week. They won't make you wealthy overnight in a raging bull market, but they tend to hold their value better when things get difficult, and they generate income that is independent of whether the price goes up. That is not financial advice. That is anatomy. Know what is inside what you own. Here is where we get practical, not theoretical, not what sounds intelligent at a dinner party, what I'd actually do. The first thing I'd do tonight, run a full autopsy on my own portfolio. Pull up every fund you own, look up the top 10 holdings, add up the percentages. If that number climbs above 25%, you have a concentration problem. It doesn't matter what the fund is called, it matters what is inside it. And if you own a target date fund, look inside that one too. Don't let the label do your thinking for you. Once you know what is actually there, the next step is to manually rewire the circulatory system. Instead of letting market cap weighting automatically route 30% of your financial blood to 7 organs. Redistribute it yourself. Equal weight index funds give all 500 companies the same allocation, regardless of size or recent momentum. International developed markets, Europe, Japan, Australia, are trading at historically low valuations compared to US stocks right now. Small and mid-cap value stocks have historically outperformed large-cap growth over 20-year periods, but have been largely left behind for nearly a decade. Here is the math that makes this concrete and personal. Say you have $500,000 in a standard S&P fund. About $150,000 of that is quietly sitting in the Big 7. If those stocks drop 50%, which happened to the Nifty 50, which happened to technology stocks from 2000 to 2002, you just lost $75,000 from that concentration alone. Now imagine you had moved $75,000 of that into equal weight or international funds 6 months earlier. Those alternatives might also drop, maybe 20%. You've lost $15,000 instead of $75,000. That is $60,000 of protection, just from recognizing a risk that was already quietly sitting inside your portfolio. The third step, set what I think of as valuation tripwires. These are automatic rules, written down, committed to in advance, before emotion enters the picture, that force you to rebalance when conditions become extreme, because in the moment, you won't want to. Human nature will tell you to hold on, to wait just a little longer, to see if it goes higher. Simple examples. If any single stock becomes more than 8% of your total portfolio, sell enough to bring it back to 8. If the S&P 500 price-to-earnings ratio climbs above 30, move 10% of your stock allocation into bonds or cash. If your top 10 holdings exceed 30% of your index fund, rebalance into equal weight. This isn't market timing, it is valuation discipline. You are not trying to predict the next crash. You are systematically limiting your exposure to expensive assets and rebalancing toward cheaper ones. Every major endowment fund operates this way. Retail investors are consistently told not to bother. The fourth step, and this one is as psychological as it is financial, is to build a cash floor. The reason people panic sell at the bottom isn't weakness of character. It is because they need the money and they have absolutely no other option. 12 months of living expenses. In a high-yield savings account earning 4 to 5%, that is not a spectacular investment return. That is insurance. It means when the market drops 30%, and at some point it will, you don't have to sell anything. You can wait. You can hold. You might even be able to buy more at prices that would have seemed impossible 6 months earlier. During 2008, people with cash reserves bought stocks at 50% off. People without cash reserves sold at 50% off, just to keep the lights on, just to make the mortgage payment. Same event, same event. Same market. Opposite outcomes. Entirely determined by one thing, having a buffer when everyone else had nothing. And the fifth step, perhaps the most honest, most human one, is to get genuinely real about your timeline. The advice to buy and hold for 30 years is good advice. If you are 25, if you are 45 and planning to retire at 60, you have 15 years. And if a serious crash arrives in year 10, you don't have time to recover. De-risking as you approach your window isn't fear. It isn't weakness. It is the same instinct a careful surgeon has, knowing exactly when to close. I am not standing here telling you the market is going to crash tomorrow. Nobody knows that. Not me. Not the hedge funds with their supercomputers and their armies of analysts. Not the person on financial television with the very confident tie and the very rehearsed certainty. Now, in 2026, the structure of the most popular investment in America quietly guarantees that if 7 specific companies have a bad decade, you have a bad decade too, whether you knew it or not. 300 years ago, a man named John Law convinced an entire country that paper backed by nothing was the same as gold, that a story was the same as substance, that belief was the same as value. Today, the financial industry has performed a quieter, more sophisticated version of that same trick, convincing an entire generation that an index fund with 30% of its weight in 7 companies is the same as true diversification. It isn't. It is a concentrated bet. Wearing a diversification costume with a very reassuring name printed neatly on the label. Go check your portfolio tonight. Not what the brochure says you own, what you actually own, What percentage of your future is quietly, invisibly dependent on 7 companies staying expensive forever? What is really inside the funds you've been told to trust without question? Because the people who built real wealth and kept it through every crash, every cycle, every moment of collective panic weren't the ones swinging for home runs. They were the ones who understood the game clearly enough to never get struck out. This has been The Autopsy. I am Jack Dawson. If you want to keep dissecting the things the financial industry would rather you didn't examine too closely, subscribe. We'll see you in the next one.
This has been The Autopsy. I'm Jack Dawson. If you want to keep dissecting the things the financial industry would rather you didn't examine too closely, subscribe. We'll see you in the next one.